People keep asking me the same question. Are you predicting some kind of economic storm in 2026? Is that why Washington is suddenly so nervous about what you're doing? Let me start with something very simple. I don't move markets with my speeches. I move markets, if at all, with my behavior. When Berkshire Hathaway sits on an unusually large pile of cash instead of buying businesses and stocks, people notice. When that cash pile grows to historic levels, at the same time the United States is running big deficits, getting its credit rating cut, and arguing about the debt ceiling, people in Washington notice even more. That's how you end up with a headline like 2026 economy prediction that has Washington panicking. It's less about a sentence I've spoken and more about a pattern people think they see in what I'm doing. I want to talk you through that pattern from my own perspective. I don't wake up in the morning and circle a date on the calendar that says crash here, panic there, crisis at this exact moment. That's not how investing works, and that's not how the economy works. But I do wake up every day and look at prices, incentives, debt levels, political behavior, and history. When enough of those variables point in the same direction, you don't need a crystal ball. You just need common sense. Right now, a lot of analysts are taking that common sense, plugging it into models, and coming up with a time frame. For quite a few of them, that time frame points toward the middle of this decade. 2026 happens to sit right in the crosshairs of several trends that are already visible today. High asset prices, big government deficits, expensive debt, and political gridlock. That's why you keep hearing my name attached to 2026, even if I haven't stood behind a podium and declared the world will change on that date. I haven't, and I won't. But I understand why people are connecting my behavior to that period. Let's start with the simplest, most visible piece of evidence people like to point at, cash. At this point, Berkshire Hathaway is holding an extraordinary amount of cash and short-term U.S. Treasury bills. It's a record for us in nominal terms and a very large share of our total assets. I've been very open about why I don't see many opportunities where the price relative to the underlying earning power of the business looks attractive enough for me to bet heavily. I prefer to risk being a little early or a little late rather than being reckless. This is not the behavior of someone who believes markets are cheap and risk is low. It is the behavior of someone who feels valuations are stretched and future returns from buying today's broad market at today's prices are likely to be lower than average. That's not a guarantee. It's an informed suspicion anchored in history. People then link that to what they call the Buffett indicator, the ratio of total stock market value to the size of the economy. When that ratio is very high, it suggests that investors are paying a lot for each dollar of national output. Recently, that ratio has been hovering in territory that in past cycles has preceded periods of lower returns or outright corrections. Add in measures like the Shiller-Cape ratio, which smooths out earnings over time, and you get a similar message. Optimism, perhaps excessive optimism, is built into many prices. Now, connect that with another reality, interest rates. I've said for years that interest rates act like gravity on asset prices. When rates are extremely low, gravity is weak, and prices can float higher. When rates rise, gravity returns and pulls valuations down. After more than a decade of exceptionally low rates, we've entered a period where money is no longer free. Yields on short-term treasuries are not trivial. They actually pay you something again. That matters for two reasons. First, it gives an investor like me a safe place to park money while waiting, instead of being forced into riskier assets just to earn a return. Second, it makes every risky asset compete harder to justify its price. If you can earn a decent return without taking much risk, the bar for buying a volatile stock or a heavily leveraged company gets higher. So you have three things happening at once. Elevated valuations by historical standards, a big pile of cash at Berkshire Hathaway, and higher interest rates that change the math for everyone. That's the market side of the story. Now let's walk over to Washington. In Washington, the numbers look different, but the logic is similar. The United States is running large budget deficits, and it has been doing that through good times and bad. The national debt has grown to levels that would have shocked earlier generations of policymakers. Recently, major credit rating agencies cut the U.S. government's rating, not because they think the country can't pay its bills in the short term, but because they see a long-term pattern of overpromising, overspending, and undertaxing, combined with political fights that make compromise difficult. When a firm like Moody's or Fitch says, in effect, we think your long-term fiscal path is riskier than before, that sends a signal. I've said publicly that I don't lose sleep over these rating downgrades when it comes to the fundamental strength of the U.S. economy. I still buy U.S. Treasury bills and consider them the safest asset on earth. But the downgrade is a mirror held up to Washington. It reflects how others see the way the country is managing its finances, and that reflection isn't flattering. I've joked in the past that I could solve the deficit problem in 5 minutes.
The proposal was simple. If the deficit exceeds a certain percentage of GDP, every member of Congress becomes ineligible for re-election. That comment was half humor and half frustration.
The frustration hasn't gone away. The incentives lining the walls of Washington often reward short-term promises and punish long-term discipline. Recently, Elon Musk dug up that old quote of mine and said he agreed with it. When someone with his audience amplifies a remark like that, it isn't because the line is cute. It's because the underlying problem has become hard to ignore. The math of debt, deficits, and interest cost doesn't care about party labels. It just keeps compounding. Now put yourself in the shoes of people who work in Washington, especially those watching the bond market and the stock market. They see deficits running high. They see interest payments on the debt consuming a growing share of the budget. They see rating agencies issuing downgrades. They see an aging population needing more health care and retirement benefits, not less. And at the same time, they look over at Berkshire Hathaway and see me sitting on a mountain of cash while saying, we're not finding many bargains. If you worked in that environment, you might start to worry that these lines will eventually intersect. That's where 2026 comes in. Why 2026 and not 2025 or 2027? The honest answer is that no one really knows the exact date when stretch systems get tested. But markets and economies tend to move in cycles that unfold over several years. The policy decisions made today don't always show up in the data tomorrow. They filter through slowly. Right now, a chain of questions is forming in people's minds. How long can we keep running large deficits while relying on investors to buy our bonds at reasonable interest rates? How long can stock prices stay elevated if earnings growth slows and borrowing costs stay high? How long can political fights over the debt ceiling, spending bills, and tax policy go on before something breaks, whether that something is market confidence, economic growth, or the patience of voters? When analysts build models and ask those questions, they often project a few years ahead. That's how you get scenarios where 2026 shows up as a year when the consequences of today's choices become harder to ignore. It doesn't mean that trouble will necessarily arrive exactly then. It means 2026 sits in the window where today's imbalances are likely to be stress tested. Here's what you need to understand about my role in all of this. I'm not trying to scare anyone. I'm not trying to cause panic in Washington, on Wall Street, or in Main Street America. I'm doing exactly what I've always done, trying to deploy capital sensibly in a world that is always uncertain, sometimes irrational, and occasionally dangerous. The reason people see my decisions as a prediction is because I've been doing this long enough that patterns tend to repeat. When I'm reluctant to buy, it's usually because I think the odds are not in our favor at current prices. When I hold a lot of cash, it's not because I love cash as an investment. It's because I don't like the alternatives enough yet. In past cycles, periods like this have sometimes been followed by moments when assets become cheaper in a hurry. Not always, but often enough that I pay attention. What makes this cycle more interesting and more uncomfortable for Washington is that the usual tools for managing stress are more constrained. If the economy slows, there will be pressure to spend more and cut taxes, which means larger deficits. But with debt already high and interest costs eating more of the budget, that path is harder to take. If the Federal Reserve cuts rates aggressively to stimulate growth, it may help in the short run, but could reignite inflation pressures which voters dislike and bond markets punish. So you have a government whose traditional responses to downturns are more limited, a market where valuations already assume quite a bit of good news, and an investor like me choosing to be patient rather than enthusiastic. Put all that in the same room, and you don't need a headline writer to stretch very far to say, this has Washington panicking. I would use a different word. I don't think panic is productive. I think realism is productive. Realism says that you can't borrow endlessly without thinking about how that debt will be serviced. Realism says that you can't count on double-digit stock returns indefinitely when you start from high valuations and higher rates. Realism says that political theater doesn't change arithmetic. When you view 2026 through that lens, it becomes less of a prediction and more of a checkpoint. If the current trends continue, 2026 may be one of those years when the world looks at the scoreboard and asks, is this sustainable? That question could be triggered by a market correction, a bond auction that goes poorly, a spike in interest costs, or a policy fight that shakes confidence. It could also arrive quietly through slower growth and tighter budgets without any single dramatic event. I'm not betting on catastrophe. I'm betting on discipline. Discipline means being willing to look foolish for a while by holding cash when others are fully invested. Discipline means refusing to chase what's fashionable just because everyone else seems to be making money doing it. Discipline means understanding that there are decades where not losing much is a form of winning. From Washington's perspective, discipline would mean finding a way to align promises with resources, not in a single year, but over a long horizon. That's harder in politics than in investing, because politicians answer to election cycles and I answer to shareholders who think in decades. But the same principles apply. When behavior diverges from arithmetic for long enough, something eventually forces them back together. So if you want to know what my 2026 economy prediction really is, here's the closest thing you'll get from me in a single sentence. If we keep doing what we're doing, paying high prices for assets, running big deficits, and assuming the bill can be pushed further into the future, then by around 2026, we're likely to find out how much strain the system can handle. That's not destiny. It's a scenario. Scenarios can change. Policies can change. Valuations can change. Investor psychology can change. The reason I talk about these things is not to declare that the outcome is fixed, but to encourage people, individual investors, policymakers, and citizens to think ahead instead of reacting in panic later. In the first part, I described 2026 not as a date on a doomsday calendar, but as a checkpoint on a road we're already driving. To understand why people connect that checkpoint with my behavior, you have to look at three pillars together: the stock market, the real economy, and the government's balance sheet. None of them exists in isolation. They lean on each other, and when one tilts too far, the others feel the pressure. Let me start with the one that gets the headlines every day: the stock market. The stock market is not a casino to me, even though some days it behaves like one. Underneath all the tickers and flashing screens, there are real businesses with factories, employees, patents, software, customers, and cash flows. Over a long enough time horizon, returns in the stock market follow the returns of the businesses underneath. In the short run, though, prices can float very far away from reality. There have been periods in my lifetime when investors became so enthusiastic, so eager not to miss out, that they paid almost any price for a piece of the action. The late 1990 seconds were like that. Certain stretches of the last decade look similar. You could tell because people stopped talking about earnings and balance sheets and started talking about stories and momentum. When the conversation shifts from what does this company earn to how fast can this stock double, you are moving from investing towards speculation. Recently, measures that compare the size of the stock market to the size of the economy have been flashing brighter than usual. One of those measures carries my name, whether I like it or not. When that ratio is high, it doesn't guarantee a crash, but historically it has meant that the air up there is thinner. Expected returns from that starting point tend to be lower simply because you are paying more up front for each dollar of future earnings. At the same time, certain parts of the market have been carrying a disproportionate share of the load. A handful of very large companies account for a big slice of the total value. Many of them are wonderful businesses with tremendous capabilities and deep competitive moats. But even a wonderful business can be a poor investment if you pay too much for it. When optimism crowds into the same names, those prices can move further away from the underlying reality. I don't sit in Omaha and proclaim which stock will fall when or where an index will be on a particular date. That's not my game. My game is to look at collections of businesses, add up their earning power, and ask whether the price I'm being asked to pay gives me a satisfactory return over time. When my answer is no more often than it is yes, you see me buy less and hold more cash. That's what you're seeing now. It isn't because I suddenly fell out of love with businesses or with America. It's because the arithmetic of prices versus earnings doesn't look especially favorable across large parts of the market. When short-term government securities offer me a respectable yield with almost no risk, I don't feel compelled to chase speculative opportunities just to stay busy. Activity is the enemy of discipline in periods like this. Now, why does this matter to the question of 2026? Because when you combine stretched valuations with higher interest rates and a high level of optimism baked into prices, you don't need a precise date to know that the next few years will probably not be as generous as the last few. That doesn't mean disaster. It can simply mean that the stock market delivers modest or even disappointing returns while earnings in the real economy try to catch up with the prices already paid. Which brings us to that second pillar, the real economy. The real economy is where people live, work, and pay their bills. It's wages, productivity, rents, mortgages, grocery bills, and business investment. It's easy to think the stock market is the economy, but that's a dangerous illusion. The stock market is a reflection, sometimes distorted, of expectations about the economy and its companies. Over the last several years, people have been through quite a lot. A pandemic, supply chain disruptions, spikes in energy prices, a surge of inflation, and then a forceful effort by the Federal Reserve to bring that inflation back down. When inflation rises, it eats away at purchasing power. When interest rates rise, they make mortgages more expensive and credit card balances heavier. Businesses face higher borrowing costs and have to be more careful about where they invest. In that environment, the real economy can look reasonably strong on the surface while still carrying a fair amount of strain underneath. Employment might be high, but many households feel squeezed by rents, medical costs, or debt payments. Companies may still be earning money, but they might postpone expansion plans because the cost of capital has climbed. Governments may still be spending, but more and more of that spending goes toward interest rather than new projects. I pay a lot of attention to how businesses we own are actually performing. Are they selling more units or simply raising prices? Are they investing in new plants and technology or sitting on their hands? Are customers paying on time or stretching out their obligations? These details don't make the front page, but added up across sectors and industries, they tell you how healthy the real economy feels from the inside. What I see is not collapse. What I see is a system adjusting to a new reality where money is no longer free, and inflation, even if it comes down from a spike, is not something you can ignore. There is still innovation. There are still entrepreneurs. There are still millions of people who get up every morning and create value. But there is also fatigue. There is caution. There is the recognition that some of the easy gains of the previous decade were built on conditions that will not last forever. When analysts project out to 2026, they are essentially asking a simple question: how will this adjustment process look after a few more years? Will wages have fully caught up with past inflation? Will businesses have worked through higher borrowing costs and found new efficiencies? Will consumers still be willing to spend, or will they be more inclined to save and repair their balance sheets? The answers to those questions matter because they determine whether the earnings that today's stock prices are banking on actually arrive. That brings us to the third pillar, the one that makes Washington nervous, the government's balance sheet. If an individual or a company spends more than it earns year after year, the outcome is fairly predictable. Debt grows, interest payments grow. At some point, the lender starts to ask harder questions or raises the interest rate to compensate for the risk. Governments have more flexibility than households, and the United States has more flexibility than most governments because the dollar plays a special role in the world. But flexibility is not the same thing as immunity. For a long time, the United States has run budget deficits in both good times and bad. When the economy is weak, deficits can make sense as a way to cushion the blow. When the economy is healthy, there is usually an opportunity to rein things in, reduce the deficit, and prepare for the next downturn. Recently, that second part has been harder to achieve. Political incentives often favor near-term spending and tax cuts over long-term arithmetic. As a result, the level of debt has climbed and the cost of servicing that debt has risen along with interest rates. Rating agencies have responded by trimming their assessments of U.S. government creditworthiness. They are sending a signal. The trajectory of promises versus resources is not on a path they consider ideal. When I see these downgrades, I don't suddenly rush to sell U.S. Treasuries and buy gold bars for a bunker in Nebraska. That's not how I think. I still consider U.S. government securities the benchmark for safety. But I also know that the laws of compound interest apply to countries just as they do to families. You cannot pile debt on top of debt forever without thinking about the day when interest payments crowd out other priorities. In Washington, people who look at the long-term budget projections know this. They see an aging population that will expect health care, pensions, and other benefits. They see tax systems that are politically hard to change. They see defense commitments around the world and domestic programs at home. And on top of all that, they see a heavier and heavier interest bill. Put that together, and you can understand why they pay attention when Berkshire Hathaway holds an enormous amount of cash. They know that if investors like me ever lose faith in the government's ability to manage its finances sensibly, the consequences could be serious. Higher borrowing costs for the government translate into higher borrowing costs for everyone. That in turn could weigh on growth, employment, and the stock market. I want to be very clear here. I am not predicting that the United States will default on its obligations. I am not predicting that the dollar will suddenly be abandoned or that the bond market will implode on a specific date. I am describing a scenario in which continued indiscipline eventually triggers a response from the very system that has been so generous for so long. Markets have a way of enforcing discipline when human beings postpone it. The reason 2026 shows up so often in these discussions is that it is far enough away for current trends to keep compounding, but close enough that people can imagine themselves living through it. If deficits stay large, if interest costs keep rising, if political fights keep blocking durable reforms, then by that time the pressure on the government's balance sheet will be noticeably greater than it is today. If at the same time the stock market has not adjusted very much and the real economy has slowed, the contrast between financial expectations and fiscal reality will be sharper. When people in Washington look at that possible future, they don't see my name in a spreadsheet. They see numbers that don't quite add up and a set of tools that are more limited than they used to be. That is enough to make them uneasy. They know that the room for mistakes is smaller. They know that if investors at home or abroad begin to question the long-term discipline of the United States, the cost of borrowing could jump in ways that are uncomfortable. So where do I fit into this picture? I fit in as a large, visible investor whose behavior gives clues about how I weigh risk and reward. When I build cash instead of chasing opportunities, some interpret that as a referendum on the future. They say I am signaling that trouble is coming. I prefer to say that I am simply refusing to close my eyes and hope that everything works out. Hope is not a strategy, and in my business, it is a poor substitute for patience. Patience allows me to acknowledge that the stock market can stay expensive longer than seems reasonable. Patience allows me to accept that governments may take longer than I would like to confront their fiscal challenges. Patience allows me to earn modest returns on safe assets while I wait for moments when fear, rather than greed, sets the price. In that sense, my so-called prediction for 2026 is not that the economy must stumble or that Washington must fail. My view is that the combination of high valuations, a still adjusting real economy, and a heavily indebted government makes this period one where caution is more valuable than bravado. The fact that some people in Washington respond to that caution with alarm says more about their awareness of the underlying issues than it does about any secret forecast I am making. History is full of moments when systems stretched themselves and then had to pull back. Sometimes the adjustment was violent, sometimes it was gradual. The difference often came down to whether leaders and citizens chose to confront reality early or postpone it until it pushed through the door uninvited. All this talk about 2026 deficits, downgrades, and my cash pile doesn't mean much if it doesn't translate into something useful for you. A headline that says Washington is panicking is exciting, but it doesn't pay your bills, send your kids to school, or secure your retirement. What matters is what you actually do with your money, your time, and your temperament. When I look at the world today, I don't see an invitation to hide under the bed. I see an invitation to be more deliberate. There is a difference between predicting the future and preparing for possibilities. I'm not in the prediction business. I'm in the preparation business. The decisions you make as a saver, an investor, or a business owner should follow the same logic. Start with your own household. Before you worry about what 2026 might bring, look at your own balance sheet. If the last few years have taught anything, it's that life can surprise you quickly. Jobs can change, health can change, markets can change. Having some cash set aside for emergencies is not a luxury. It's a form of self-respect. It gives you the ability to say no to bad deals, to avoid selling good assets at a bad time, and to sleep at night when the headlines turn noisy. Debt is a useful tool when used sparingly and with clear purpose. It becomes a trap when it is used to pretend you can afford a lifestyle that your income does not justify. If you head into any uncertain period, whether it's 2026 or any other year, with high interest debt and no cushion, you are effectively betting that everything will go right. That is not how I invest, and it is not how I suggest people live. You do not need to eliminate all debt, but you should understand which obligations could hurt you if interest rates stay high or your income dips. For most individuals, the best investment approach is boring, and that's why it works. Owning a broad, low-cost slice of productive businesses through an index fund, adding steadily over time, and ignoring short-term market drama has been a remarkably effective strategy. You do not have to guess what the market will do in 2026. You have to decide what you will do if the market falls or rises. Will you panic and sell at the bottom, or will you stick to a plan? Having a plan matters more than having a forecast. When I say be fearful when others are greedy, and greedy when others are fearful, people sometimes hear a call to heroism. They imagine themselves swooping in at the perfect moment, buying at the exact bottom. That is not what I mean. I am talking about attitude, not precision. If 2026 turns out to be a year when people are scared and prices are down, the right attitude is not despair, it is curiosity. You should be asking, are there good businesses now trading at prices that give me a margin of safety? If the answer is yes, and your finances are in order, that fear is your opportunity, not your enemy. For those who choose to pick individual stocks rather than buy the entire market, the standard is higher. You have to understand the businesses you own, not just the symbols on a screen. In a world where interest rates are higher and growth is less certain, quality matters even more. Companies with durable competitive advantages, sensible management, strong balance sheets, and real cash flows are the ones more likely to handle storms. Flashy stories with little substance are the ones more likely to disappoint. If you decide to invest the way I do, you don't need to know what the market will do next year. You need to know what your companies are likely to earn over many years and whether the price you pay today leaves room for error. If you run a small business, the headlines about 2026 are background noise compared to the realities you face every day. You live in the real economy. You see customers walking in the door, suppliers sending invoices, employees dealing with rising costs. For you, the question is not what will the S&P 500 do? The question is, can my business survive and thrive if financing stays expensive, if demand softens, or if regulations shift? The same principles I use at Berkshire Hathaway apply at a smaller scale. Avoid stretching your balance sheet to the point where a small shock becomes fatal. Be cautious about expansions that only work if everything goes perfectly. Invest in improvements that genuinely increase your efficiency or your appeal to customers, not in decorations that just make you feel successful. The economy may slow, competitors may struggle. Those who have managed their risks thoughtfully will be the ones left standing to pick up market share. None of this means you should spend your life waiting for disaster. It means you should build your affairs so that you do not need perfect conditions to be okay. If 2026 turns out to be a relatively calm year, a strong balance sheet and disciplined investing will still serve you well. If it turns out to be turbulent, those same habits may make the difference between opportunity and regret. Now let me come back to Washington, because whether you care about politics or not, decisions made there shape the environment you live in. You and I cannot personally rewrite the tax code or the federal budget, but we are not powerless. We can pay attention, we can vote, we can support leaders who treat numbers as seriously as slogans. We can resist the temptation to believe that everything we want can be delivered without trade-offs. I've joked about fixing the deficit by tying re-election eligibility to fiscal discipline. The joke landed because people sense the truth behind it. Incentives matter. If the easiest way to stay in office is to promise more and more while sending the bill into the future, then it should not surprise you that the bill keeps growing. When Washington looks at 2026 and feels nervous, part of that nervousness comes from the recognition that these patterns cannot extend indefinitely without consequences. I do not expect perfection from policymakers any more than I expect perfection from markets. What I hope for is a gradual shift toward more honesty about the choices ahead. You cannot have every benefit without cost. You cannot keep piling obligations onto future generations and assume they will be happy to pay the tab. Sooner or later, the arithmetic asserts itself. Despite these concerns, my long-term outlook on the United States is not grim. Quite the opposite. I've spent my life investing in this country because it has an extraordinary capacity for reinvention. It has a legal system that, while imperfect, generally protects property rights. It has a culture that encourages innovation and allows failure without turning it into permanent exile. It has millions of people who wake up each day and try to build something better than what existed before. Those strengths do not vanish because the debt is high or ratings have been trimmed, but they can be undermined if discipline disappears. The real risk is not that one particular year brings a shock. The real risk is that complacency erodes the habits that made the country strong in the first place. If 2026 becomes a moment when people wake up to those habits again, the discomfort may prove healthy. The same is true at the individual level. The danger is not that the market falls in a given year. The danger is that you react in a way that turns a temporary decline into a permanent loss. If you sell a sound investment out of fear and never get back in, your portfolio may never recover what it could have, even if the economy and markets bounce back. On the other hand, if you approach downturns with a calm mind and a prepared plan, you can turn volatility into a tailwind rather than a headwind. For a young person just starting to save, 2026 is one small dot in a long line of years ahead. If you let worry over that dot keep you from owning productive assets, you may miss decades of compounding. The biggest risk for someone with a multi-decade horizon is not a market correction. It is never getting started or quitting too soon. You do not have to be brave. You do have to be consistent. For someone close to retirement, the situation is different. There is less time to recover from big mistakes, which makes planning all the more important. That might mean holding a larger portion of safe assets to cover near-term living expenses so that you are not forced to sell stocks in the middle of a downturn. It might mean accepting slightly lower potential returns in exchange for more stability. There is no one formula, but the principle is the same. Design your finances so that you are not at the mercy of a single year's market performance. Through all of this, remember that my own behavior is guided by the same ideas I'm describing. I hold a large cache of cash, not because I know exactly when I'll need it, but because I know that at some point the world will offer up bargains to those who are ready. I stay invested in strong businesses because I know the long-term trajectory of human ingenuity has been upward despite wars, crises, and political dramas that felt all-consuming at the time. I pay attention to deficits and downgrades because they tell me something about the environment, but I do not let them paralyze me. So when you hear that my 2026 economy prediction has Washington panicking, translate that headline into something more practical. The reality is that I am acknowledging risks that are visible today, acting in ways that keep my options open tomorrow, and trusting that opportunities will appear for those who remain solvent, patient, and rational. You can do the same on your own scale. You do not need to forecast the exact path of interest rates, elections, or corporate earnings. You need to decide how you will behave when the world surprises you. Will you build your life on hope that nothing will go wrong, or on resilience that allows you to keep going when something does? Will you chase whatever is fashionable in the moment, or will you commit to a strategy you understand and can stick with? If 2026 turns out to be just another year, with no particular drama, you will not regret having been prudent. If it turns out to be a year when some of today's tensions come to a head, you will be grateful for every bit of discipline you practiced. Either way, the real prediction I'm making is not about a date on the calendar. It is about the enduring value of patience, simplicity, and realism. The economy will surprise us, as it always has. Markets will rise and fall. Washington will argue. News anchors will find new phrases for old anxieties. Through it all, the basic principles do not change. Spend less than you earn, avoid unnecessary debt, own pieces of productive businesses, keep some cash for emergencies and opportunities, ignore the noise as much as you can, trust time more than timing. If you do those things, you don't need me or anyone else to tell you what will happen in 2026. You will be ready to live with whatever happens, and that, in the end, is the only kind of prediction that truly matters. When you strip away all the noise about ratings, deficits, elections, and market predictions, the quiet lesson sitting underneath this whole discussion is actually very simple. The future is uncertain, but your habits don't have to be. You and I cannot control what happens in 2026 or any other year. We can't control what politicians will do, how markets will react, or when the next surprise shows up. What we can control is how prepared we are, how much we depend on perfection, and whether we anchor our decisions in discipline or in impulse. The meaningful lesson, at least the way I see it, is this: resilience beats prediction. If your life, your business, and your portfolio are built on the assumption that everything must go right, then any shock will feel like the end of the world. But if you build on margin of safety, keeping some cash, avoiding reckless debt, owning solid businesses instead of chasing fads, then even a rough year becomes survivable and sometimes even an opportunity. That's true for countries, and it's true for individuals, arithmetic will win in the long run. Your job is to be standing when it does. And now, as we wrap up this video, I'd like to hand the conversation back to you. We've talked about cash piles, Washington 2026, and all the worries wrapped around those ideas. But the real question is, how are you positioning yourself? Are you changing anything about the way you save or invest after hearing this? Are you tightening up your own balance sheet or staying the course? Let me know down in the comments what part of this discussion resonated with you most and what you're planning to do differently, if anything, over the next few years. I genuinely enjoy reading different perspectives, and you might be surprised how much others can learn from your experience too. If you think someone in your family or your circle of friends would benefit from hearing a calmer, long-term view of all this panic, feel free to share this video with them. And if you'd like to keep following along as we break down what's happening in the economy, markets, and policy in a straightforward, no-drama way, consider subscribing to the channel and turning on notifications so you don't miss the next video. Thank you for spending your time here with me today. Take care of your finances, take care of your family, and I'll see you in the next one.